ETPs trade like normal equities, normal stocks on an exchange. This is different from traditional mutual funds where you can buy the product once a day. With ETPs, one of the main benefits is that you can buy the product throughout the day, throughout the normal trading day, which is normally 8 to 4:30 p.m. UK time. On-exchange trade works with an exchange providing a venue for market participants to meet, to buy and sell. Normally they designate an official market maker. An official market maker is someone who will give a buy and sell price throughout the trading day, which investors then trade against. The advantages of an order book are that you have anonymity. So as an investor, you don't know exactly who you're trading against. Which can be an advantage. Second advantage is that you have multiple market makers competing to give you prices, normally resulting in a lower price, and also that it's centrally cleared. With over-the-counter trading, you go directly to one market participant. They then give you a price for the product based on where they see it. The advantage of that is that you can normally do much larger sizes than you can do on exchange, and also that you can tailor the trade to specific nuances that you want. For example, if you want the trade to settle early, you can ask for that in an OTC trade. The disadvantages are that because you're dealing with one counterparty, there's no central clearing, so the risks related to that are much higher. And also, there's no multiple counterparties, so you need to ring up each market participant consecutively to get good prices. Risk trading is a method of trading where you're given a price by a market maker, and if you like that price, your trade is completed at that price. The market maker then takes the full risk onto her or his book to make sure that that trade is completed at a profit for that market maker. For NAV trading is where you trade at the market closed for the underlying constituents. So, for example, if the commodities markets all close at between 7 to 9 p.m. UK time, you know that your trade will be completed around 7 to 9 p.m. when all of the different underlying markets are closed. The advantage is that they can often be much cheaper than a risk trade, but you do have to wait until 7 to 9 p.m. for it to be traded. So if the market then moves up and you're a buyer, you will have missed all the price performance for that day. The best times to trade ETPs, firstly, is if you're trading a product where there are several underlying constituents, is to make sure you know when those underlying constituents are open. So for example, for multiple commodity products, many of the best times to trade are in the afternoon, because that's when most of the market makers who are market making the underlying constituents are trading them in America. If that's not the case, and the underlying constituents are closed all the way through the day that you're trading, the best time to trade is when the American market is open, which is normally 2:30 p.m. UK time. The reason why that is the case is because there's a lot more certainty in the market over where the markets are going to go for the next 2 or 3 hours, because the US market is the biggest market. It's also the last market in the Western world to be open through that trading day. There are two main methods for investors to buy our product. Firstly, through platforms. Platforms allow investors to either log on or to talk to their advisor, and their advisor will then trade the products on their behalf. So when they're logging on, they can select the product and they can trade accordingly, or the advisor can do it for them. This is normally applicable for retail investors all the way up to high net worth individuals or private wealth individuals. The second way is more applicable for institutional clients. Institutional clients will normally trade with multiple different market participants. In this particular instance, they should always go to 2 or 3 different market participants to get best prices. ETP pricing works with reference to the underlying constituents. So, for example, if you have a basket of precious metals products, a market maker would take the price of gold, silver, platinum, palladium in the market right now, and they would price it accordingly. They also add something called risk onto it. So the market maker will add a risk element to the pricing of the underlying constituents to make sure that they're covered for profit and covered for any big moves in the market, to make sure that they reduce the risk as much as possible that they're wrong. Firstly, when trading on exchange, to use limit orders where possible to protect yourself against adverse movements in the market. Secondly, to know the underlying constituents, to know when the best times to trade them are, and preferably to trade them when the underlying constituents are actually open. Thirdly, to actually monitor the buy and sell prices of the products for a couple of days beforehand, so you know whether you're getting a good deal or not.